Hey guys, it is Julie here with TipRanks, and today we're taking a look at two unanimous strong buy stocks under $5 a share. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at two companies that have been on the decline so far this year, but despite that they are picking up all buy ratings from Wall Street analysts, and currently priced under $5 per share could be quite the deal. Of course, keep in mind with cheap stocks like this, there is a lot of volatility as well, so don't jump in without assessing your own risk tolerance and investment plan. Today, we're going to take a look at these two companies, what it is that they do, and what Wall Street analysts are predicting for their stock's future. Don't forget to download the TipRanks mobile app so you can access all your favorite research tools on the go. Links are in the description down below. Now let's get into these two cheap, strong buy stocks. First up, we're taking a look at Clean Energy Fuels. Their stock trades under the ticker CLNE, currently priced at $3.87. They are down from a yearly high here of $7.73 back in November. The stock has fallen 20% over this past year. Clean Energy Fuels, as the name suggests, is involved in clean energy with the production of biofuels, particularly renewable natural gas or RNG for use as a transportation fuel derived from organic waste. There is no shortage of organic waste in our industrial society, and Clean Energy Fuels is working to turn a problem into a solution, and one that can replace diesel fuel for both a lower cost and a 300% reduction in carbon emissions. They're already the largest provider of RNG to the U.S. automotive industry as a vehicle fuel, and the company counts both UPS and the New York City Metro Transit Authority among its existing customers. They'll be sharing their next quarterly report on November 8th, and this follows the last quarter at the start of August where they did come out with an earnings beat. While Q2 revenue of $86.95 million was a few million shy of expectations, their flat earnings per share came in 2 cents better than anticipated. During the quarter, they saw their RNG gallons sold rise over 17%, and they announced a joint development agreement with Tourmaline, which is Canada's largest natural gas producer. They also announced new RNG fueling agreements with several well-known consumer brands and some of the nation's largest and most environmentally conscious transit agencies. Their chief executive officer noted that they had a nice rebound in their financial results coming off historically high natural gas prices in California in the first quarter of 2023. Demand for RNG by their fleet customers remains strong, and they remain very excited about the multitude of positive factors taking shape around RNG. One analyst with Raymond James recently upgraded the clean energy stock to a strong buy from an outperform. They noted that the company is on the cusp of ramping up in-house renewable natural gas production, and the Treasury's Section 45Z decision is on deck. The firm says that this section should provide a massive boost to the profitability of RNG projects, especially the dairy-based varieties starting in January of 2025. Clean Energy Fuels has picked up 8 unanimous buy ratings from Wall Street, and their average price target for the stock comes in at $9.36, which would be a massive upside potential of 142% from current prices. Down below, we can see a recent rating coming in just 2 days ago from Scotiabank with a price target of $8, which would be an upside of 106%. Here is that upgraded Raymond James rating at $6 with 54%, and one huge rating from a couple months ago from Lake Street. Our second beaten down strong buy stock is Hecla Mining Co. Their stock trades under the ticker HL, currently priced at $4.21. Now, if we look at the full past year, the stock comes out fairly flat, but year to date, they have fallen nearly 26% from highs of nearly $7 per share. Hecla Mining is a precious metals company. The company has been in the business for more than 130 years and are the oldest New York Stock Exchange listed precious metals mining company in North America. They produce more than 45% of all silver in the U.S. and are the third largest lead and zinc producer, and also mine gold. They have operating mines in Alaska, Idaho, Quebec, and Yukon Territory. With their last quarterly earnings report on August 9th, they did come out with an earnings beat. For their second quarter, they reported earnings per share of 3 cents, coming in a couple cents ahead of estimates, and they also produced 7.9 million ounces of silver in the first half of the year, which is the third highest silver production over a 6-month period in company history. Sales came in at $178.1 million. And just yesterday, Hecla provided some updates on their Q3 silver production. While they say their Q3 silver production is down 8% versus the previous quarter, their production does continue to grow with almost 1 million ounces more this year compared to the first 3 quarters last year. Despite less production at the Lucky Friday, Greens Creek consistent performance and the ramp-up of Keno Hill should allow them to be within their 2023 guidance. With their silver production expected to increase to about 20 million ounces by 2025, Hecla remains the world's fastest-growing established silver producer, the largest in the U.S., and remains on track to become Canada's largest next year. Following this production update, we have an upgraded buy rating from Roth and a newly initiated buy rating from BMO. BMO capital analyst Kevin O'Halloran noted that the company's gold production exceeded expectations in Q3 and that their resilience despite a production outage at Lucky Friday further underscores their potential. They see the Hecla Mining Company as a premium silver producer, attributing this to their low-cost profile, especially at Greens Creek, and their operations in prime locations. Hecla Mining has also picked up 8 unanimous buy ratings from Wall Street, and their average price target comes in at $6.43 for an upside potential of about 53%. Down below here, we can see that upgraded buy rating coming in yesterday with an upside of 5%, and BMO being a bit more bullish here with an upside of 31%. Our slightly older price targets from a couple months ago around 30 to 67% upside, and a high end at 115%. So there we have 2 companies that are in the red year to date, but have analysts feeling seemingly optimistic about their future growth potential. Let me know your thoughts on these 2 companies in the comments down below. I always love hearing from you guys. And again, just a reminder, any of these cheap stocks can be quite volatile, so always approach with caution and do your own research and due diligence before making any investment decision. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.